This just happened, and if you blinked, you missed how violent it was. Silver dropped 37% in 48 hours. Roughly $1.4 trillion evaporated, almost overnight. And here's the part that makes this urgent right now. JPMorgan Chase is openly warning that silver could retrace toward the $50 area, which would mean roughly 50% downside from the recent $120 highs. That's not a hot take. That's a risk flag. Stay with me because I'm going to show you what actually caused this move, why it matters now, and how you can recognize this setup before it bites again. Before I explain what caused the crash, let me teach you something most people don't really internalize about markets. Price doesn't move on belief alone. It moves on positioning. Think of a crowded elevator. Everyone fits while it's going up, but when the doors jam and someone panics, the rush for the exit is what creates the damage. In markets, leverage is that crowding force. It amplifies gains on the way up, and it accelerates pain on the way down. So when you see a market that's gone parabolic, your first question shouldn't be, is the story true? It should be, how leveraged is this trade? And that distinction matters more than you think, because narratives can be completely valid and price can still collapse. The story about inflation can be real. The story about currency debasement can be accurate. But if everyone who believes that story is using 10-to-1 leverage on futures contracts, you've got a structural problem that has nothing to do with whether they're right or wrong. When leverage unwinds, it doesn't discriminate. It just exits. So what does that tell us? It tells us that markets have two layers. There's the fundamental layer, the big picture story, the macro thesis, and then there's the technical layer, the positioning, the leverage, the plumbing. Most people only watch the first layer. They get married to the narrative, they ignore the second layer until it punches them in the face. Your job, if you're watching this right now, is to watch both. Always. Now let me show you what's actually happening in silver, because this is where it gets mechanical. Over the last year, silver rallied about 260% year over year. That kind of move doesn't come from long-term stackers alone. It pulls in momentum funds, short-term speculators, and futures traders using leverage. As price rips higher, exchanges tighten margin requirements. That's normal. That's not manipulation. That's risk management. But here's the cascade. When volatility spikes, margin calls hit. Traders are forced to sell futures, not because they want to, not because the story changed, but because they have to. That forced selling pushes price lower, which triggers more margin calls, which forces more selling. It's mechanical. It feeds on itself. And the speed of the drop tells you everything about how thin the real liquidity was underneath that rally. Here's what I mean by thin liquidity. Imagine you're standing in a market where everyone's buying, but nobody's really committed to holding through volatility. They're in because it's going up. The moment it reverses, there's no natural buyer stepping in at $95 saying, hey, I'll take all you've got. There's just more sellers hitting bids that keep dropping. That's what thin liquidity looks like, and that's what happened here. Now let me layer in the second piece, because it's not just margin calls. It's also how the futures market interacts with physical. When futures price drops hard and fast, it creates temporary dislocations. You get situations where futures are trading below physical premiums, or where the basis blows out. Arbitrage players step in eventually, but not instantly. And in that window, the selling pressure in paper markets can overwhelm everything else. So you've got forced liquidation from margin calls. You've got thin liquidity because speculative longs evaporate. And you've got a temporary disconnect between paper and physical. All three hit at once. That's not a coincidence, that's a convergence. And when those three forces align, you get moves that look insane on a chart but make perfect sense when you understand the mechanics. But here's the part that should make you nervous if you're not paying attention. Once a cascade like this starts, it doesn't care how bullish you are. It doesn't care if you've done your research. It doesn't care if you believe in the long-term thesis. It only cares about who needs to exit right now. And if you're leveraged, or if you're holding in an account that can't stomach volatility, you're going to be part of that exit whether you like it or not. Now let me show you what very few people are actually talking about. The narrative didn't break first. Liquidity did. Go back and look at the headlines before this crash. Were people suddenly bearish on silver? No. Were the fundamentals falling apart? No. The story about silver didn't suddenly turn negative. What happened was the plumbing cracked. And when liquidity cracks in a leveraged market, price doesn't drift. It falls, fast. So when JPMorgan steps in and says we see risk back toward $50, they're not calling silver dead. They're calling out the math. High leverage plus parabolic price equals fragile structure. That's the convergence. The rally invited leverage. Volatility tightened margins. Forced selling proved how thin the market really was. That's not opinion. That's sequence. That's cause and effect playing out exactly how it always does in overleveraged parabolic moves. And if this feels familiar, it should. This is the exact same playbook silver ran in the late 1970s. Let me take you back there for a second. In 1979 and early 1980, silver went absolutely parabolic. It ran from around $5 an ounce to nearly $50 in a matter of months. The story was inflation, currency crisis, the Hunt brothers accumulating physical. The narrative was powerful. People were euphoric. And then it crashed. Silver gave back roughly 50% of that move mid-cycle before it found any kind of footing. What happened next? Well, it didn't go to zero. It didn't mean the bull market was over forever. But it shook out everyone who was overleveraged, everyone who bought the top, everyone who assumed the move would just keep going in a straight line. Same pattern we're seeing today: explosive upside, euphoric headlines, then a brutal drawdown that deleverages the trade and forces weak hands out. Now fast forward to 2011. Silver screamed higher again. It went from around $17 to nearly $50 in less than a year. The narrative was quantitative easing, money printing, fear of fiat currency collapse. Sound familiar? And what happened? It collapsed nearly 50% over the next few months. It punished late buyers. It crushed anyone using leverage. And only later, after the volatility cooled and the excess washed out, did it stabilize and eventually try to rebuild. Every time silver runs like this, the same thing happens. It surges, it overextends, it deleverages, and then it rebuilds. The pattern doesn't change. The players change. The narrative details change. But the structure is identical. Zoom out and you see it clearly. Silver doesn't move smoothly. It never has. It rips higher, attracts speculation, gets overleveraged, and then violently resets. If you know this history, you're not surprised by what just happened. You're just watching the cycle repeat. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be manipulation? Could banks be talking it down? Could this be coordinated selling to shake retail out before the next leg higher? Let me be honest with you. Maybe. Those arguments exist. People make them every single time silver drops. And you know what? Some of them might even be partially true. But here's the thing. It doesn't actually matter whether there's manipulation or not when it comes to managing your risk. You can't control narratives. You can't trade intentions. You can't build a position around what you think someone else is secretly planning. What you can control is your exposure, your leverage, and your timing. The chart doesn't care who's right morally. It only reflects who's forced to act financially. So instead of getting caught up in blame or conspiracy, focus on the mechanics. Focus on what's observable. Did leverage exist? Yes. Did volatility spike? Yes. Did forced selling happen? Yes. That's enough. You don't need a villain to explain a deleveraging event. You just need over-leveraged positioning and a catalyst. And we had both. Could this crash be a buying opportunity? Could it be a gift for people who missed the rally? Yes, it could be. But slow down. Deleveraging phases take time. They don't end in one candle. The first drop is rarely the final low. Volatility needs to cool. Margin pressure needs to release. The weak hands need to fully exit. That process doesn't happen overnight. So if you're thinking about stepping in, be patient. Let the dust settle. Watch for stabilization, not just a bounce. Now, there are probably 3 types of people watching this right now. Let me speak to each of you directly, because your situation is different, and the approach you take should reflect that. First, you're long silver, and you're feeling punched in the gut right now. Maybe you bought near the highs. Maybe you've been holding for months and just watched your gains evaporate in 2 days. Maybe you're sitting there wondering if you should sell, if you should hold, if you made a terrible mistake. Let me tell you something. Your job right now isn't to panic. It's to assess whether you're over-leveraged and whether price is stabilizing. If you're holding physical and you don't have margin calls, you're not forced to do anything. You can ride this out. You can wait for the market to rebuild. But if you're holding futures or leveraged positions, you need to be honest about your risk. Can you handle more downside? Can you stomach another leg lower if this isn't done yet? If the answer is no, reducing exposure isn't weakness. It's risk management. And there's no shame in taking some off the table to sleep better at night. Second, you missed the run, and you're wondering if this crash is your chance. You watched silver go from $40 to $120, and you didn't pull the trigger. Now it's back under 80, and you're thinking maybe this is it. Maybe this is the dip to buy. And you know what? Maybe it is. But let me give you some advice. Don't rush. Deleveraging phases take time. The first bounce isn't always the bottom. Wait for signs of stabilization. Wait for volatility to compress. Wait for the market to show you that the selling pressure is exhausted. What does that look like? It looks like price holding a level for more than a day or two. It looks like volume declining on down moves and increasing on up moves. It looks like implied volatility starting to drop instead of spike. Those are the signs that the panic is fading and the structure is firming up. Until you see that, you're catching a falling knife. And catching falling knives is how you lose money fast. Third, you're a trader looking for opportunity. You don't care about the long-term thesis. You just want to capitalize on volatility and momentum. If that's you, your edge comes from patience and timing. Big moves don't end in one candle. They end after exhaustion, so watch for capitulation volume. Watch for a climax low where everyone who's going to sell has sold. Watch for the first real bounce that holds. That's your entry signal, not the initial crash. And here's the universal principle that applies to all three of you, no matter where you stand. Don't chase vertical moves. Don't assume the first crash is the last. Markets need to breathe. They need to reset. They need to find equilibrium. Trying to force a trade in the middle of chaos is how you get hurt. Wait for clarity. Wait for structure. Let the market tell you when it's ready. So here's what I want you to answer in the comments. Which type are you? Are you long and holding? Are you waiting for a setup? Are you trading the volatility? And what's your biggest question about managing risk in a move like this? I read every comment, and I want to know where you're at because it helps me understand what's actually useful to you. Now let me tell you where I stand, because I think you deserve to know how I'm looking at this. I'm not bearish on silver long term. I think the fundamental case for precious metals is still intact. I think the macro backdrop of currency debasement, deficit spending, and geopolitical instability hasn't changed. But I'm cautious right now. And here's why. First, I'm watching the $95 to $100 zone for stabilization. If silver can hold above that range and base there for a week or two, that tells me the deleveraging might be close to done. It doesn't mean we're going straight back up, but it means the structure is firming. If we break below 95 with conviction, then I'm looking lower. The next zone I'm watching is $70 to $80. That's a deeper deleveraging pocket, and it's possible if volatility stays elevated and more forced selling hits. Second, I'm watching physical premiums. If premiums stay elevated or expand even as futures drop, that tells me there's a disconnect between paper and physical. That's actually constructive long-term because it means real demand is still there. But if premiums collapse with futures, that's a different story. That tells me even physical buyers are stepping back, which means the fear is broader. Third, I'm monitoring implied volatility. If volatility starts to compress, that's a sign that the panic is fading. Options traders are pricing in less chaos. Margin requirements might start to ease. That creates room for the market to stabilize. But if volatility stays spiked or goes higher, that tells me we're not done yet. More selling could be coming. Based on my analysis, this move was mechanical, not emotional. It was structural, not narrative-driven. The fundamental picture for silver hasn't vanished. The case for owning precious metals as a hedge against currency risk, inflation, and systemic uncertainty is still valid. But the excess leverage that built up during the rally needed to unwind. And that's what we just saw. It was violent because it was forced. It was fast because liquidity was thin. And it's not over until the volatility tells us it's over. If history rhymes, and I think it does, silver survives this. It doesn't go to zero. It doesn't mean the bull market is dead. But it also doesn't mean we're out of the woods yet. The pattern says we get a reset, we get a base, and then we get another attempt higher. But that takes time. It takes stabilization. It takes the weak hands exiting and the strong hands accumulating. We're in the middle of that process right now, not at the end of it. Now let me be clear about something. I'm not a financial advisor. This is not financial advice. Everything I just told you is my perspective, based on how I read markets, how I interpret data, and how I've seen these patterns play out before. You need to do your own research. You need to assess your own risk tolerance. You need to make your own decisions. Don't take my word for anything. Verify it. Challenge it. Think critically. That's how you get better at this. If you made it this far, you're exactly the kind of person who's going to navigate markets better than 90% of people out there. You're not looking for hot tips. You're not chasing hype. You're trying to understand how things work. And that mentality will serve you well, not just in this trade, but in every market you ever touch. If this breakdown helped you see the mechanics behind the move, share it with someone who needs to hear it. If you want more analysis like this, hit subscribe so you don't miss the next one. And if you've got questions or thoughts, drop them in the comments. I want to hear where you're at and what you're watching. Stay sharp out there, think critically, verify data, and make your own decisions.